Hi, and welcome back to the Food Fund, where we analyze investing in food stocks, beverage stocks, and restaurant stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in the best food companies. Is a popular confectionery company a good investment? In this video we will be analyzing if Hershey Stock is a buy. Could Hershey, stock ticker symbol HSY, be ready to rocket back to all-time highs? Let's find out. We have a lot to cover, so let's go ahead and jump right in. Cue the logo. Let's start with some background info on Hershey. Hershey was founded in 1894 when Milton S. Hershey, inspired by his love for confectionery, opened the first Hershey chocolate factory in Derry Township, Pennsylvania. From humble beginnings, Hershey grew into a confectionery giant with a commitment to quality and innovation. They offer a wide range of chocolate products, including bars, candies, and snacks, featuring iconic brands like Hershey's, Reese's, and Kisses. Today, Hershey boasts a global presence with operations in numerous countries and its headquarters still located in Hershey, Pennsylvania. Now let's look at the price action. Starting with the 1-year chart, we see that Hershey had a CAGR of about -15%. Zooming out to the 5-year chart, we see that Hershey had a CAGR of 6%. Hershey has long been a slow steady gainer but has pulled back in recent quarters. It looks like a solid support is forming, which may help catapult the share price higher. A backtest comparison of investing $10,000 in Hershey versus the S&P 500 reveals some interesting results. Hershey underperforms the S&P 500 across multiple metrics. While Hershey started with a balance of $10,000, it ended with $14,745, yielding an annualized return of 8.84%. In contrast, the S&P 500 began with the same amount but finished at $18,352, achieving an annualized return of 14.17%. Hershey's performance was also more volatile, with a standard deviation of 17.71% compared to the S&P 500's 18.76%. Hershey's best year saw a growth of 29.55%, marginally outperforming the S&P 500's 28.75%. Hershey suffered a slightly better downturn, with a worst year of -17.88% versus the S&P 500's -18.17%. Maximum drawdown, however, was more severe for Hershey at -30.74% compared to -23.93% for the S&P 500. Finally, Hershey significantly underperformed the S&P 500 in terms of risk-adjusted returns, with a Sharpe ratio of 0.43 and a Sortino ratio of 0.69, while the S&P 500 boasted a Sharpe ratio of 0.68 and a Sortino ratio of 1.07. Now let's hop over to market share and take a look at Hershey's market share. Here we have the dashboard, where we can quickly gather a lot of information at a glance. Expanding the dashboard, we can look under food and see that Hershey is categorized as a confectionery company. Expanding the confectionery tab, we can see that Hershey has the second largest market share of the 3 confectionery companies listed, but it does appear to be gaining market share. Let's look closer at the year-by-year changes in market share. So we come down here and type in the ticker symbol for Hershey, HSY, and see that the market share is 1.34% out of the publicly traded food, beverage, and restaurant stocks currently in the market. Hershey attracts a fair amount of food spend and has been growing market share. The 5-year market share CAGR for Hershey is 1.89%. This means that consumers are choosing to spend an increasingly larger portion of their food budget on Hershey products. If we start in 2020, we see that the market share was 1.26%, 1.2% in 2021, 1.26% in 2022, 1.3% in 2023, and 1.34% over the trailing 12 months. Despite the market share decline in 2021, Hershey has come roaring back and has been growing market share ever since. Of note, the market share data is from Q1 because not all of the included companies have reported Q2 earnings yet. Let's take a look at the fundamentals to learn more. Gross margin is 45%. This is on par with similar confectionery companies. Revenue has compounded at around 9% over the past 5 years and has reached over $11 billion most recently. Hershey's revenue had been growing very nicely but has started to decline during the trailing 12 months. When we look at cash flow, we see a 7% CAGR over the last 5 years for operating cash flow, while capex has worsened at a 18% CAGR. As a result, free cash flow has grown at an 3% CAGR. It is kind of worrisome to see operating cash flow and free cash flow declining from their peak while capex continues to grow. That said, Hershey still produces more than $1 billion in free cash flow every 12 months. Ideally, they would use that capital to invest in a strategy that will return the company to free cash flow growth. Weighted average shares outstanding have fallen over the last 5 years, going from 209.4 million shares in 2020 to 204.7 million shares most recently. Hershey has been buying back shares. I love to see this. Hershey is using their free cash flow to buy back shares, improving the per share metrics. Now let's view return on invested capital. Return on invested capital has fallen from 22.8% in 2020 to 20.9% most recently. While this value is still high, I do not like the downwards trend. Clearly, Hershey is having a tough time generating growing returns from their investments. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from 55 days in 2020 to 48 days most recently, Hershey had gotten more efficient, but the trend is now moving upwards. Unfortunately, it looks like their inventory is starting to pile up, which is a very bad sign. Now, let's look at Hershey's debt. The net debt to EBITDA has actually remained the same over time, going from 1.8 in 2020 to 1.8 most recently. This debt is not too high in my opinion, and I would prefer that Hershey use its free cash flow to restart growth instead of trying to pay down debt aggressively. Last, let's explore dividends. Current dividend yield is 2.75% with a dividend payout ratio of 57%. Hershey is paying out dividends that its earnings can support. This indicates that the company's dividend practice should be sustainable. Dividends per share for this company have grown at a 12.2% dividend per share CAGR over the past 5 years and a 10.2% dividend per share CAGR over the past 10 years. Hershey's dividend history looks very robust and has a strong dividend growth rate. Hershey's sweetness seems to be diminishing a bit. In any event, should it remain in the portfolio? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Hershey. It is a food company with a gross margin of 45%. The 5-year revenue per share CAGR is 10% and the 5-year free cash flow per share CAGR is 3%. This is an excellent example of a great gross margin and steady revenue and free cash flow growth. I can dig it. A return on invested capital of 21% is good, but the trend is worsening. Next, the cash conversion cycle of 48 days is pretty high and seems to be getting worse. Concerning debt, a net debt to EBITDA of 1.8 means that it would take Hershey nearly 2 years of earnings to pay off their debt. So from a fundamental standpoint, Hershey does have some challenges. Now let's switch our attention over to valuation. Hershey is fairly valued relative to the S&P 500 with a ratio of 1. The price to earnings growth, or PEG ratio, is 17.2, indicating that Hershey is massively overvalued relative to their projected earnings growth. Hershey is a well-known food company and a stock I hold in the portfolio. However, I do have some concerns about the company's future. While up on the 5-year time frame, revenue and free cash flow have been declining over the past few quarters. Efficiency metrics like return on invested capital and cash conversion cycle are also trending in a bad direction. Notably, Hershey's gross margin has actually not changed over the past 5 years, indicating that Hershey has done a good job of passing on the cost of rising cocoa prices to the consumer. However, the consumer recently has begun to pull back spending, resulting in slowing sales. The Q2 update of market share should provide valuable insights, but if I had to guess, I would assume that the consumer pullback is not hurting Hershey alone but most of the food companies. Still, I am pretty optimistic that Hershey's market share has not taken a beating and may have even grown. Before we wrap up, we definitely need to talk about the high PEG ratio. Clearly, analysts think earnings growth is going to be an issue for the company over the next few years. However, Hershey's trailing 12 months earnings per share have come in higher and higher year over year. With the ability to leverage share buybacks to prop up earnings per share growth, I think Hershey might be able to avoid massive earnings decline. So, while Hershey has some trends that investors definitely need to keep their eye on, I still think it is a sweet company to own. It's important to remember that investing is a marathon, not a sprint. We want to find companies that are consistently creating value for shareholders, and I think Hershey will continue to do just that. Many thanks for watching. What do you think about Hershey and their future prospects? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.